Moving on to the broken wing put butterflies. And again, I'm going to do it the same way as with the call butterflies. We're going to do the standard, the one that most people do with the put butterfly from the long position. The one long in the money put, we're going to sell two at the money puts, skip a strike, and buy one out of the money put. So in this example, again, we would be skipping a strike. And the general location of the lowest long put will be just in the money, and the highest long strike will be further from the base of the butterfly than the lowest long put. So what that's saying is, if there was one strike in between the in the money put to the two at the money puts, then our out of the money put would be two strikes higher. This is a skewed butterfly, and with one of the wings strikes being further away, and this creates the directionality. In this case, a long put butterfly, when we skew it this way, we actually want this to continue to go higher, and it creates more risk, but it's still defined. It's creating more risk for us, but that gives us the credit. And you will sometimes see it as a debit spread, but at the end of the day, if I'm creating more risk, I'm not going to pay the debit, so I try to stay away from those unless I have a real directional assumption. And the broken wing butterfly will again want to implement this in a high implied volatility environment, and if we're concerned about the downside risk. And what we want the implied volatility, that vega again, to contract. In all of these strategies, we're looking for the vega to contract. And in this particular put butterfly with the broken wing, we are wanting the underlying to pin right at our base or our two short strikes. The max profit is going to be the higher strike minus the middle strike plus the net premium received, and our max loss is going to be the skipped strike minus the lower strike minus the net credit received, and our break even is going to be that skipped strike price minus the credit received. So in this particular example of the broken wing put butterfly, we're using Walmart again. Walmart's trading right around $72.50. So I picked that as our base. So we bought 173 put. We sold two 72.5 puts. And then we skipped the 72 put and bought a 71.5 put. And we got a net credit of 14 cents. Now you can see with this put butterfly, it's skewed for the upside. So if we were worried about upside, that's when we would put on this put butterfly. And the max profit would be achieved when Walmart trades or stays right here at $72.50. If it continued to rally to the upside, you can see that we would be able to create or keep our credit of 14 cents. That is our profit to the upside, or our break even, if you will, to the upside. It's not really a break even because we are staying profitable to the upside for $14 here. And to the downside, if this did break to the downside, our break even would happen when it sold off to the skipped strike price minus the net credit received. So our skipped strike price was $72 minus the $14. So our break even is if Walmart or the underlying would be trading at $71.86. That's where the line crosses, the red line crosses the dotted line. And our max loss would be when our skipped strike price minus the lower strike price minus the net credit received. So the $72 strike minus the $71.5 strike is 50 cents, and then subtract the 14 cent credit. So 50 cents minus the 14 cent credit gives us $36. That would be our max loss for the broken wing put butterfly. Good. Going on to the next broken wing put butterfly. This is going to be one where I like to use more often. It is all out of the money strikes. We are going to use one long out of the money put, then sell two out of the money puts, and then buy one further extended out of the money put, or a skipped strike. And the lowest long put will be just out of the money, and the longest long strike will be further from the base of the butterfly than the lowest long put. Just all that's saying is we are skipping one strike. So if we were using the 73, 72, we would skip the 71 put and go to the 70 put. The broken wing long butterfly out of the money is skewed with one of the wings strike prices being further away. This creates the directionality, and it creates a little bit more risk than the regular butterfly, and this will also give us a net credit. When to implement this? Again, we are going to implement this strategy, this broken wing butterfly, in high implied volatility environments. And if we're concerned about the upside risk of this underlying. We may think it's going to stay right here, but we're really concerned about the upside. This will give us some upside potential still. On the downside is where we will lose money if it turns around and goes the other way. And what we want is we want this underlying to have high implied volatility, and we want this option to have high vega, and we want to see that vega contract during the life of this contract, or during the life of when we're holding this contract. We want the underlying to sell off and pin at our short strike. So because this is out of the money, keep in mind the underlying is trading above all of our strikes, so we want this underlying to sell off a little bit right to our base price or our base strikes and pin there. But if it continues to go upward, we will still receive our net credit. The max profit on the broken wing put butterfly that's out of the money, it's going to be our max profit is equal to our higher strike minus the middle strike plus the net premium received, and our max loss is going to be the skipped strike price, the one that's not in the strategy, minus the lower strike minus the net credit. And our break even would be the skipped strike price minus the net credit. These are all very similar in regards to how you figure on the profit, the loss, and the break even. You just kind of have to think about it just a little bit. As you can see here in our graph of the broken wing put butterfly, which is out of the money, we have Walmart that was trading right around $72.50. It's just a little bit above that. So we bought the 72.5 put. We sold two of the 72 puts, and we bought a skip strike of 71 puts. Keep in mind, if this was the butterfly, we would be using the 71.5 puts. But we skipped that strike to give us a net credit of $15, or the 15 cents. Just keep in mind, when you're using options, everything's multiplied by 100. If it's a 15-cent credit, it's actually $15. So our max profit, we want this to sell off a little bit and pin at our 72 strike. Remember, Walmart's trading just above $72.50. So we want it to sell off a little bit and pin at the 72. But if it were to continue to rally up into the 73 handle, 74 handle, we are still going to collect our 15-cent credit. But if it were to sell off and it went past our 71.5 skip strike by 15 cents, that's where we would incur our break even, as you can see on the graph. So we used the 71.5 skip strike to figure out our break even. We would subtract 71.5 minus the net credit which gives you 71.35. So if the underlying trades to 71.35, that is our break even. And if the underlying continues down, then our max loss would be the skip strike price, which is 71.5, minus our lower strike, which is 71. The difference there is 50 cents minus our net credit received, which is 50 cents minus the 15 cents. Our max loss, as you can see on the graph, is $35. All right, well, that's all I've got for you today. I got a lot jammed in here in this half an hour section, but it's a lot to really think about. Some of you may want to rewatch this, revisit this online tutorial one more time just to kind of get it down pat. It is a little bit odd in the fact that when you're buying a put butterfly here from the long side, you're getting a credit and we're looking for upside, and everything is counterintuitive in a sense, but those are the things that you really need to hammer out in your head here a couple of times over it. It should straighten out.
Doesn't really see what's going on. I want to see the counter side of it. I like to see everybody else's perspective. I don't want to get caught in my tunnel vision thinking. So please comment on these videos. If you can't take that, take it easy.